but want to respect everybody's time. Hi, everyone. Dave Beamstover with United Philanthropy Forum. Welcome to our regular program, Ask the Nonprofit Lawyer. We're pleased to be joined once again by Jeff Tenenbaum with Tenenbaum Law Group. Welcome, Jeff. Good to see you.
Thank you,
always. And we have a few questions that folks submitted ahead of time to ask of Jeff that I shared with him yesterday. So we're going to get started with those, and then there'll be plenty of time for you to ask other questions of Jeff and take advantage of his legal expertise. The first question is from Ashley at Catalyst for San Diego and Imperial Counties. This is a question that comes up every now and then, Jeff, an important one. Should membership dues have a fair market value, or can they be considered donations entirely? From a legal or tax perspective, is either approach preferred?
So it's a great question, one we deal with quite often. And the first thing you got to do is look at it both from the perspective of the payor/donor and the recipient organization, because they're two different constructs and two different set of rules essentially that apply, and they don't necessarily have to correlate. So for instance, how something is treated for tax purposes by the payor or donor does not have to match up with how the organization treats it from a tax perspective. So first off, from the payor or donor's perspective, presuming all of your organizations are 501c3 organizations. So for 501c3s, if someone is making a donation, meaning and for charitable tax deductibility purposes, it means that it has to have donative intent, meaning someone is intending to make a donation as opposed to paying for products or services, and the amount subject to a charitable tax deduction is the amount that's greater than the value that someone gets in return. So generally speaking, now some C3s, like here in DC where I'm based, the Smithsonian, which is a 501c3 organization, they have kind of members of Smithsonian, but being a member there is basically just being a donor. A number of other like conservation groups and some other groups have that. Basically you make a donation of a certain amount, you become a member, and you get whatever monthly newsletter and maybe some preferred access to, opening events and things like that. But it's largely just a donation as opposed to like a 501c3 membership organization. That's kind of a classic membership organization where in exchange for membership dues, you get a whole host of certain benefits, member benefits, more than just the de minimis stuff that I talked about. If it's the latter, where you're paying membership dues to be a member and you get certain membership benefits and whatnot, that's generally not going to ever be considered to have donative intent. So the donor payor is never going to be able to take a charitable tax deduction because it's presumed that whatever the payor is getting in return for that membership dues payment is the fair market value of the payment. And so A, there's no donative intent, and B, even if there was, the value of what they got in return is going to equal the amount of the payment. So there's not going, for both reasons, there's not going to be any charitable tax deduction. Whereas if it's really just a member in name only, not a member, say for purposes of like every state and DC's nonprofit corporation statute, has this construct for nonprofit corporations where you either have voting members or you don't. Most of your organizations probably don't have voting members. Some of you probably do. But if your articles of incorporation and your bylaws say you do not have voting members, but you still can call people members for purposes of whatever, recognizing higher dollar donors or whatnot, that's a different story. And in that situation, there probably is donative intent, and any benefits they get are probably de minimis. But certainly, whatever, even if they have some value, the organization would, as you always have to do for any contribution to a C3 charitable contribution over $75, the recipient organization, as you know, has to give written substantiation as to the value of what the donor got in return. You know, you pay $150 for, you know, an annual dinner. On the charitable gift receipt, you know, thank you. The charity, the C3 tells the donor, thank you for your $150 contribution. Please note that the value of the dinner that you're getting in return, food and drink, is $75. Therefore, the charitable tax deductibility is limited to that $75 that exceeded the $75 fair market value of the dinner, the food and drink that the person got in return. So you have to analyze it from that perspective. Finally, the last thing I'd say on the donor or payer side is that if you're, say, a C3, like professional membership association, of which there are a lot in the US, probably not as much in your membership, but you know, in the classic association world, there's quite a number of 501c3 professional membership organizations. There, the payer is likely able to take a business tax deduction for their payment, for the full amount of the payment, because it's in furtherance of their business. So like we represent the American Institute of Architects, just as an example, professional membership association. Members that pay dues to AIA are generally architects or others in the architectural field, and the payment is in furtherance of their business interests. It's what's considered an ordinary necessary business expense. So they can take a full business tax deduction for that payment. So you got charitable deductibility, tax deductibility, and business tax deductibility. So if it's in that latter situation, then they can take a business tax deduction. And because there's no donative intent involved, the C3 doesn't have to give any kind of charitable gift receipt or anything like that. Hopefully that makes sense. From the 501c3 recipients organization, it probably doesn't matter. I mean, the only case it would matter is for public support test purposes. So as you may know, all 501c3s are subclassified into public charities or private foundations. Most of your organizations are likely public charities, but to be your private foundation by default, unless you meet one of the 3 public support tests to essentially show that you get your money from multiple different sources. And that it's a more tax beneficial status to be a public charity as opposed to a private benefit. So for public, you know, the first 2, they're called 509A1, 509A2, and 509A3. 509A1 and A2, there is kind of a distinction between contribution income and grant income, and then, you know, what we call like program service revenue, things like membership dues, conference registration fees, publication sales, things like that. And so how the money, what bucket it gets put in, can have an effect on the public support test. In the end, probably is not going to matter much. But that's really from, otherwise though, you know, whether the C3 is booking it as membership dues or whether they're booking it as contribution income, it's all going to be tax-free income to the organization. So it's not about taxability from the recipient's organization, but it could affect theoretically in some cases, you know, whether or not you qualify that year for the public support test. And from a kind of a non-tax legal perspective, I'm not sure there's really any difference. You know, of course, you got, like I said before, the issue of charitable gift receipts. If you believe there's donative intent and it's over $75 and they get something in return, then you got to give that gift receipt that talks about the value, identifies the fair market value of what they got in return. Sorry, that was a long, complex answer, but it's not a simple question. Hopefully that makes sense. Did anyone have any follow-up questions on that?
Well, go ahead, Nancy. I do too, but go ahead, Nancy.
So I'm an anomaly in the PSO space in that our dues are an elective structure. So our base dues are $500, and then there's
wait, first tell me the organization. And
it's Grantmakers Council for Rhode Island. Okay,
and the members are grant making organizations, presumably, right?
Yeah,
and they're probably all C3s themselves. Right?
No, I have a lot of corporations and some foundations. And so the baseline is 500. Anybody who pays that is a member, but then you can elect to do a higher level to support GCRI. So we have members who pay in the upper levels, not based on anything other than their contribution to the organization. So I've just been, when I've been asked, saying the $500 is the services that they get, and anything that they pay over that is charitable. Is that kosher? Because they're all getting the same services.
Yeah. I think so. I mean, you have essentially a hybrid situation where the $500 is the payment, not contribution, but the payment for membership dues for the services, benefits, whatever that they get in return. So that amount, you know, if it's for profit, say professional fundraiser or whatever other company, I'm sure you got a lot of ancillary companies in the grant making space, you know, vendors and others like that. They probably are taking a business tax deduction for that $500 payment. If it's a C3 that's making the payment, it probably doesn't matter to them, you know, because they're not taking charitable or business tax deductions anyway. But then, yeah, if you distinguish, if the amount over 500 is essentially just a charitable contribution, again, if that amount is paid by a C3, like another C3, really doesn't matter because it's consistent with their C3 purposes. They can do that, and they're not taking a charitable tax deduction anyway. But for the for-profits, or even like an individual professional fundraiser, if you had one, you know, they can probably take a charitable tax deduction for the amount over $500. But your receipt for the dues, and I put it in parentheses because it's really a dues plus a contribution.
Yeah.
You know, like in some organizations, you know, like I'm a member of the American Bar Association. Whenever I get my annual ABA membership dues statement, it's a C6, but they'll say, you know, ABA is a C6, you know, they'll say, you know, your dues are whatever, $500, $700, whatever they are for the year. But then do you want to make an extra contribution to the ABA? I forget the name of their related C3. It's has to do with social justice. You know, do you want to make an extra contribution to, you know, to our related C3 foundation? And if you do, then you get a charitable gift receipt back, you know, that says, you know, thank you for your $100 contribution to the foundation. And that is certainly subject. That's clearly has donative intent, and you're not getting anything in return for that. So you just want to distinguish that on the gift receipt and make that clear so that people have the option. Another important thing to keep in mind is, I've always told this to, you know, tax exempt clients of mine, C3s in particular, is that you should never be giving tax advice to donors or payers. You know, if they ask you, can I take a charitable tax deduction? Can I take a business tax deduction? You're never supposed to be giving them advice. Say, check with your own, you know, tax advisor, accountant, lawyer, whatever, on that, because it's a very fact specific determination. You know, what's subject to a business tax deduction for one company might not be for them, because it depends on their business purpose. And just don't get into that. Just be sure to say $500 is for the membership services you're getting, and anything over it is a donation to our organization. And you're not getting anything else in return for that.
Right. Okay. Thank you.
Thanks, Jeff. I have two follow-ups to this question. This, as you said, is complicated. Kind of connected to what Nancy just asked. We do have members, and including the organization I used to run before I came here, where it's a little different from Nancy's, where there are definite tiers based on, say, size, the amount of grant making. So there could be 8 or 10 different membership dues tiers. And our members will get a question, particularly usually from a corporate member, about what is the value of the dues. And there's been this unwritten rule floating around in our network for a long time that would say the lowest dues level on that tier is what you can say is the value of the membership, so that the rest could be considered a contribution as a practice. But it's not elective like in Nancy's case. It's like if you're this size, you pay this amount.
And so, you know, first off, when you're valuing what they get in return, you're supposed to put the fair market value of what they're getting in return. So that fair market value should be determined irrespective of the size of the entity that's making the payment. Right? You know, it is what it is. You know, if you valued it at $500, you know, like in Nancy's example, then it's $500. But the difference, you know, that's why I said it's a very fact-specific determination. In your example, Dave, the difference is there's no donative intent, because those larger entities don't have a choice. You know, you're not saying you can pay $500 and get $500 worth of benefits. You're saying you have to pay more because you're larger. And I do, as you know, a lot of work with trade and professional associations, including I have a number of 501c6 clients where in a number of industries, they base their membership dues based on the annual revenues of the company. Sometimes number of employees, sometimes number of offices. I have a client, America's Blood Centers, that calculates it based on the number of like sticks in arms, every year, and that's how they calculate their membership dues. But well, they're a C6, so it kind of doesn't matter. But even if you're a C3, there's not going to be donative intent because the donor doesn't have an option. So either way, they're not going to be eligible for a charitable tax deduction.
Okay, thank you. That's helpful.
But
And-
again, that's for them to determine. not
Right,
for you.
exactly, yeah. And Michelle from Philanthropy Missouri, she just went off camera, but she had a question. Do you want to just share it?
Sure. I think it's in the same zone, and I'm just wanting to make sure because I'm not sure I'm tracking all of it, Jeff. But we're looking at a model where we're specifically responding to members wanting to be able to classify what has been in the past dues as a grant. So it is not overhead for their grant making organization. And so looking at something like Nancy described, where there's a minimum level that everybody pays, and then what would have been up to like $9,000 or $10,000 worth of dues, then is a grant that is unrestricted, that supports our mission broadly. Is this still in the same zone that you've been describing, or have we ventured off into something else that we need to be thinking about?
First off, it's a little different because we're not talking about charitable tax deductibility, because an exempt organization doesn't take charitable tax deductions. It's really a question of how they're going to book it.
Well, and I should clarify, 50% of our members or more are corporations, so they
Okay.
may be. So
And-
I guess, yeah, the people asking us for this are the nonprofits who don't want it to be overhead, and we have corporate members who may opt into it as well.
Yeah, the corporate members, for them, I can't imagine they're going to call it a grant. And
Okay.
they don't care. They don't have to deal with overhead issues
Okay.
and 990 disclosures. So for them, they're going to take a business tax deduction for the whole thing anyway.
Okay,
For them,
Then
it
that's-
really
then
doesn't
we're not-
matter. But
okay.
for the C3s, yeah, I mean, as long as it's essentially voluntary, right?
Mhm.
Then again, it's their legal compliance, their appropriate accounting for how they book it. So that really shouldn't affect you. But, as long as it's voluntary and it's not, mandatory part of the dues payment, if you wanted to identify it in a receipt or something, thank you for your grant of, X thousand dollars this year,
Yeah,
unrestricted grant or whatever, I don't have any problem with that.
got it. Thank you. Appreciate it.
Thanks, Jeff. Okay, so the next question is Hugo from, Carrie. Do you
Steve,
have a
could I
follow-up?
just chime in? I don't
Sure.
know if it's directly related, but it's a similar kind of question that we got for the first time this year from a member. And she said, for our 990, we report the dollars allocated for lobbying. Does a percentage of the membership dues for ICOF go towards lobbying? If so, can you provide the percent or dollar amount? So first time I've gotten that question in 7 years. Yes, we lobby, but I don't think we take like a member's specific membership dues to support that work. It's actually a super, super small percentage of our work, as you might imagine. So, I mean, I said, talk to your auditor, whatever, but I don't know. I've just never gotten that question. Wonder if anyone else has. And then Jeff kind of wondered what your thoughts on that would be.
So this is an issue that comes up a lot. By the way, I just posted in the chat a link to a new article of ours about the lobbying rules for 501c3 organizations. So for any of you that do even a small amount of lobbying, you still have to comply with these rules. For C3s, as you probably all know, C3s are allowed to lobby. You're just limited in how much lobbying you can do. There's two sets of rules. One, if you make the 501h lobbying election, which for all of your organizations, I don't think there's any reason why you should not make it, and every reason why you should. And the article talks about that. For if you don't make that election, then you're governed by this kind of vague, no substantial part test. But you can lobby just within limits, and you have to track it. And what happens is that if you're a C3 organization that's paying money to another organization that lobbies, could be a C3, could be a C6, example of like I gave you my client America's Blood Centers. ABC itself is a C6, but most of their blood centers are C3s. And so regardless, whether you're paying it to a C3 or a C6, if some of the money could be used for lobbying by the recipient organization, whether it's C3 or C6, then the C3 that's paying that amount has to treat a portion of that at least as lobbying for their own books. Now, if they pay it to you, but it says, there's some restriction that says it can be used for anything other than lobbying, then they would not. But usually that's not going to be the case with membership dues, right? It's going to be unrestricted. And so they're going to, that's why you got the question, Carrie, because, their auditors are probably asking, okay, you're making this unrestricted payment to an organization that does some lobbying, so what percentage of the dues I paid are being used for lobbying? And you can't just say, well, we're not using any of your member dues because we're just using other funds for lobbying. I mean, unless so there's very specific rules for 501c6s when it comes to this stuff. It's very different for C3s. There's not any hard and fast rules, but the typical practice is to take, your total unrestricted income, like dues and other similar payments, compare it to your lobbying expenses compared to your total expenses, figure out what that percentage is. So say, lobbying constitutes 5% of your overall budget. Then the typical practice would be for your organization to tell the C3s and others that are paying, actually it applies to even the for-profits as well, tell them that 5% of your membership dues is used by our organization to lobby on your behalf, on Capitol Hill, federal agencies, or whatever else. Lobbying, by the way, for C3 purposes only includes legislative lobbying, not regulatory or executive branch lobbying. So if 5% of your overall budget is devoted to legislative lobbying, and that's the number that you report, on the Form 990 that you file each year, then you should be telling them that 5% of your membership dues is used for lobbying. So for C3s that are paying those amounts, they would count that and add that to their lobbying expenses at the end of the year. And for like for-profits that are paying you that amount, the lobbying tax rules that I referred earlier for C6s, corollary part of those rules say that for-profit companies that spend money on lobbying, they cannot take a business tax deduction for those lobbying expenses. And so the for-profits need to know that, because while they can take a business tax deduction in that example for 95% of the dues payment, they cannot take it for the 5%. And so that's the way you should be doing it. Now, it's not a mandate for you to do that. But, obviously, Carrie, you got to ask, so you should tell them that information. But it really is a best practice, and you really all should be doing that. Presumably, it's going to be a pretty small amount in most of your cases. Some of you might not do any lobbying, any legislative lobbying. But if you do any federal, state, or local legislative lobbying, you should do that sort of calculation and report back to everyone who pays dues that percentage.
And would you suggest doing that in their receipt? Or
Yeah, and it would typically either be done on the membership dues invoice or on the receipt, if you give them like a thank you email or something in a receipt. Yeah.
Can I just ask?
Again, I just
in
want
the
to stress
chat
it. It's not an express mandate on you to do that, like it is for 501c6 organizations, but it is kind of a best practice and something you really should be doing.
Okay, thanks. That's helpful. And I'd be interested for the others on the call, if anyone is doing this yet and maybe have sample language I could look at. Thanks.
Yeah, I mean, it would be as simple as saying, thank you for your, let's say $500 membership dues payment. Please note that, 5% of this payment is used by, our Iowa Council on Foundations, for legislative lobbying on your behalf, something like that. That's all you need to say.
Great, thanks.
And Carrie, we can certainly ask on the, if no one has other examples, we can ask on the listserv about that. So we're going to switch gears here to a pretty relevant topic. Jeff, what do organizations need to keep in mind as they offer remote work options to allow people to work from anywhere, for example, international work, etc.? moving to another country, or obviously to another state from where the organization may be technically headquartered. Certainly in our network, more and more, this is coming up more and more, the remote work reality.
Okay, I'll answer that question, but just one final postscript to the last discussion. If you have never been doing that in terms of disclosing the amount of lobbying that you do, there's no express obligation for you to do that. So if you don't do it and no one's asking you about it, I wouldn't lose any sleep over it if I were your lawyer, put it that way. Because there's no express obligation to do it. I'm just saying, I've seen it done. I'd say my guess is in these kind of situations, the majority of C3s that lobby and that receive membership dues probably don't do this sort of reporting.
I would guess most of our members do not do that. Even though we have a number of members who lobby. I think most are like Carrie, where it's a small percentage. And what complicates it is that some of our members, as was discussed earlier, some of our members, they get their dues in form of a grant. And a lot of foundations still require you, when you get the grant, to sign something saying none of this is going to be used for lobbying.
Exactly. And that's also because if the grant's coming from a private foundation, remember, referred earlier to private foundations versus public charities, they're all C3s, but private foundations have a lot more restrictions. And one of them is that they can't spend money on lobbying.
Right.
So that's why they want an attestation that none of their funds are going to be used for lobbying. And, if I don't think this is common, but if you had a situation where your lobbying is totally funded by, I don't know, I know the Gates Foundation makes some grants to some organizations expressly for lobbying, sometimes it's things like election reform and other things like that, domestically in foreign countries, things like that. So if all of your lobbying is paid for by one source, and you can truly say that none of your membership dues are being used for lobbying, then I'd be very comfortable not making the disclosure for sure. But, if your lobbying is just funded from general funds, then anyway. All right, so your question about remote work, I did one of these kind of ask the nonprofit lawyer sessions yesterday in person, actually right across the street behind me. And I got this question, we ended up spending probably 20 minutes of the 45-minute session talking about this. There were so many follow-up questions, and for good reason. It's an area that's very top of mind, very relevant to most nonprofit organizations, and it's complicated. So a few things to keep in mind. First off, you don't have to offer remote work options to anyone, with one maybe small exception, under laws like the Americans with Disabilities Act. If someone has a qualifying medical condition that makes it risky for them to come into the office or something, you have to make a reasonable accommodation for them, so long as they can still perform the essential functions of the job with the accommodation, and the accommodation doesn't pose an undue burden. And so for people with very, chronic sensitive health conditions where it's really dangerous, risky for them to be around other people, especially during COVID, but even in other times, that could be a reasonable accommodation that you offer to someone, but it doesn't necessarily mean it's the only one, even if they wanted it. But that aside, I think most of you probably allow remote work for most of your workers, most of your employees. Maybe it might be some exceptions for some where it just can't be done, like people who are staffing in-person meetings, or if you have a receptionist at the office who needs to be there to greet people, or larger organizations still have people that deliver the mail and things like that. For situations like that, some positions might not lend themselves to remote work while others do. It's very important that you have a very solid written remote work policy. Usually it's part of your employee handbook. And one of the keys is that you need to treat all similarly situated employees the same, consistently, objectively and consistently. So otherwise you risk discrimination claims, that you're allowing, your white employees to work remotely, but you have an African-American employee who's not allowed to, and they claim discrimination. If you can point to the fact that the African-American employee does a job that does not lend itself to remote work, at least most of the time, then that could justify that differential treatment. but otherwise you have to treat people objectively and consistently. Secondly, if you are going to allow remote work for some or all positions, whether it's full-time, 3 days a week, we're seeing all sorts of hybrid arrangements. You can restrict from where they can remote work. It's not all or nothing. It's not, you can work anywhere in the country or you can't remote work at all. Or you could work anywhere in the world or you can't remote work at all. You are allowed to impose restrictions, again, as long as you apply them across the board. So we have some clients, for instance, who say you can remote work, like I'm in DC, they'll say you can remote work from DC, Maryland, or Virginia, 3 days a week, 5 days a week, whatever it is, but not anywhere else. We have some that say you can remote work from anywhere except California, because California has at least for larger states, the most employee-friendly employment laws and a number of other laws. And some employers just don't, because the reason this is relevant is that where your employee is principally based is where the employment laws from that state are going to apply to that employee. Even if you only have one employee in California, that employee is subject to California's employment laws. So for instance, California's employment laws say for non-exempt employees, you have to pay them overtime at time and a half for any time worked over 8 hours in a day. Whereas the federal rule, and in most other states, it's, overtime for non-exempt employees over 40 hours in a week. So you could work, 10 hours one day, 6 hours the next day, that sort of thing, and regulate it to keep people from going over 40. But in California, it doesn't work that way. And there's a lot of other very unique laws in California that are very employee friendly. So if you want to say, you can remote work from anywhere but there, that's fine. If you want to say you can remote work from anywhere in the US, but not overseas, that's fine. An issue came up in yesterday's session that kind of led to a good point that I hadn't really thought about before, which is you definitely want to mandate to your employees that they have to let you know where they are principally working from and if that changes, right? Because, there were some questions about, well, say like, I'm gonna use a California example again. Someone's remote working principally from California. It's not only the employment laws that apply, but all these other tax and business license and regulatory requirements that also kick in: qualification to do business as a foreign corporation, registering for unemployment compensation and taxes in that state. And someone asked, well, what if someone moved to another state but never told us, and then they get fired and they seek unemployment insurance, unemployment compensation, and they're not eligible because you never registered there. Then you got a question, they said, well, wouldn't the employer be off the hook from making any payments because the employee never told them? And I think you would have a stronger argument if you have a policy that requires them to tell you that. Either way, they're not going to be eligible for kind of the state system of unemployment or workers' comp or things like that. But then it's a question of whether the employer could be held liable. But regardless, I think from that, I'd say it's absolutely should be a best practice to make sure employees tell you where they're remote working from. And then, the last thing is, it's for those of you who have dealt with this, and I know many of you have, it's complicated. It's a pain in the neck. It's difficult. If you find one, let me know, but I've yet to find a company like a vendor that does all of this stuff for you in every state. There are some that do some parts of it, like ADP, payroll provider, does some of the payroll tax registrations in the different states for withholding and things like that. But I've yet to find one that does all of it. But it's a lot of work, and it's ongoing work. And I'm constantly hearing from clients like getting delinquency notices and things like that, for not properly timely registering and paying into the tax system there and all sorts of things, payroll taxes. And so just keep that in mind, that you can impose restrictions, just got to do it objectively and consistently.
Great, thanks, Jeff. That's really, really helpful guidance and advice. So we do have a question. Christy from Wisconsin Philanthropy Network is here on the line. And I should have asked, this is connected back to lobbying and IRS rules for reporting lobbying. She asked, as a 501c3, does the IRS rules for reporting lobbying as a 501c3 include an exemption for communications over mass media? And Christy, was there another part to that question? I wasn't sure, but that was the part. It seems like a part of your question got cut off, but That's the part I
Oh,
caught.
yeah, sorry. Part of the question got cut off. It was, so this is a question that we got directly from a member. And it was whether or not IRS rules for reporting lobbying include an exemption for communication over mass media or directed at public audiences.
Yeah, so this is a little more complicated one, and I already, for the prior question, I posted in the chat this new article of ours about lobbying rules for C3s. So first off, remember I said that there's two sets of lobbying rules for C3. The more favorable set of rules that you have to elect to be governed by, that's called the 501H election. You file this simple form, half-page form of the IRS one time, and then you're automatically governed by those more favorable set of rules. There's clear definitions of lobbying. There's clear definitions of what's not lobbying, like all the regulatory, administrative branch, executive branch stuff. There's a lot of exceptions from lobbying, and there's numeric, dollar limits on how much lobbying you can do. Whereas if you don't make the election, all of it's vague and none of this is well defined. For if you make the 501H election, it's all about how much money you spend on lobbying. Volunteer time doesn't count, things like that. But one of the things the 501H rules, some people refer to them as the 4911 rules because they're in section 4911 of the federal tax code. There is a distinction. There's whatever your lobbying limit is, the overall lobbying limit, there's a sub limit of 25% of that amount for grassroots lobbying. And grassroots lobbying is essentially when you go out to the general public, not just your members, but the general public, running, TV, radio, newspaper, internet, whatever ads that, say, please contact your member of Congress or member of your state legislature and urge them to vote for or against this particular bill for whatever reasons. And because grassroots lobbying is sublimited to 25% of the total amount, it's very important. And because some of this grassroots advertising can be very expensive, you can quickly reach that 25% limit. And so be cognizant of that. But there is this special rule, and it's you'll see it in the article in the section called Other Special Rules for 501H Electors. There's number 2 refers to mass media communications. And here's basically what the rule says. There's a presumption that mass media advertisements, like on TV, radio, newspapers, etc., which would otherwise constitute a non-lobbying activity, or things like issue advocacy, like just getting out the word on a particular issue, but not making the ask, and please contact the member of our state legislature to urge them to vote against this bill. Even if it's otherwise like issue advocacy, it's going to be considered a grassroots lobbying communication if it appears within 2 weeks of a vote on the legislation by either a legislative body or a committee. If it too reflects a view on the general subject of the legislation, and C, either refers to the highly publicized legislation or encourages members of the general public to contact members of the legislature or their staff about the general subject of the litigation. So again, I don't think this rule is going to come into play that often for most of you guys, maybe none of you, but that is something to be cognizant of. But irrespective of this rule, if you're going out to the general public and saying, please vote for or against this legislation, that's going to be grassroots lobbying regardless. But this, anyway, I just wanted you to be aware of that since you're asking the question. And when the question also referred to as the state of Wisconsin rules do. So lobbying for C3s is regulated by the IRS only at the federal level, the limitation on lobbying. No states have a limitation on lobbying, but most states have, just like there is at the federal level, there's a Federal Lobbying Disclosure Act that's regulated by Congress. And then most states have a State Lobbying Disclosure Act. It's called different things in different states. Does not in any way regulate lobbying, but it does, it doesn't not in any way limit lobbying, but it does require you to register and report if you're engaging in certain amounts and certain types of lobbying each year. And so if there's some exemption in Wisconsin, it's got to be an exemption from the Wisconsin Lobbying Disclosure Act. So it's not about what you can and can't do. It's just about what you have to report on.
Great. Thanks, Christy, for that question. Thanks, Jeff. Laura in Ohio has a question related to sponsorships. Laura, do you just want to ask it?
Yeah, sure. Thanks, Dave. And I will apologize if I have to step away in just a second. I'll still be here, but I may have to walk away for a moment if I'm not responsive. But
No worries.
here is my question. So we solicit sponsorships for our annual conference. And so what we have been telling people, we do not provide free registrations in exchange for the sponsorship. But every year we get the question of our sponsor, like are any seats included in our sponsorship? And so what we have told people
Wait,
is that,
what? I couldn't hear that word. Or what included in your sponsorship?
seats. So like a free registration in
registration.
exchange for my $20,000 sponsorship. And so we have been telling our sponsors that no, because that would provide more than what is considered incidental benefit for their gift. And so we have said that we cannot allow for free registrations, but we get this question every year. And what we are trying to grapple with is we understand that a lot of other organizations do offer in exchange for a high-level sponsorship, some kind of, free registration or 2 free registrations. And it would be helpful in marketing those opportunities. So the questions that we have are, one, can you do that? Is that permissible? And then if we do that, do we have to do anything different with documentation? And then third, more anecdotally, is that common practice, best practice for sponsorship? So we're just trying to understand, are we behind the curve and not offering that? Or is our legal parameter actually where we should stay?
Great question. Short answer is yes, you're behind the curve, and yes, you can be offering that, but it's about how you go about doing it. And your comment about documentation is a key one. So here's where this comes from. I just posted in the chat another pretty new article of ours about unrelated business income tax for nonprofits. And one of the sections in that article is all about the corporate sponsorship rules and the corporate sponsorship exception from unrelated business income tax. So taking a step back, all tax exempt organizations are subject to, at the federal level, unrelated business income tax on their net income from regularly carried on trade or business activities that are not substantially related to your mission and your purpose. And the most common form of unrelated business income for tax exempt organizations by far is advertising income. If you earn advertising, like in your newsletters, magazines, journals, things like that, it's going to be subject to unrelated business income tax. That's a 21% tax at the federal level. If your state has a state corporate income tax, it's going to be subject to that as well. You have to report it each year on the IRS Form 990T, which is a separate form, which is also subject to public disclosure for C3 organizations. And you have to make quarterly estimated tax payments. And you can deduct your directly connected expenses in calculating your net income. So that's the general rule. But then there are a number of exceptions to unrelated business income tax. Some of the most common in your world would be the exceptions for royalties, for corporate sponsorships, for convention and qualified convention and trade show revenue, for interest, annuities, dividends, capital gains. There's the volunteer labor exception that says if 85% or more of the labor of an activity is conducted by unpaid volunteers, that's also exempt from UBIT. And there are a number of others as well, most of which are not typically as relevant to your organizations. But so even if something is a regularly carried on business activity that's not substantially related to your mission and your purpose, like advertising, but if you can convert it into a qualified corporate sponsorship payment by taking advantage of this exception in the tax code that's been around since, I think, 1995, then you can convert what is otherwise taxable advertising income into tax-free corporate sponsorship income. And the basic construct, these rules are modeled after the Federal Communication Commission's rules for public broadcasting and what they are allowed to do and accept money from corporate sponsors. And there it's a question of what sort of benefits can be provided to the corporate sponsor to be allowable under the FCC rules for public broadcasters. Here, it's not about what's allowed, it's about what's subject to this exception. And so the basic idea is that if you're just acknowledging a contribution and you're not providing what the IRS calls a substantial return benefit to the sponsor, then the amount should all be exempt as a qualified corporate sponsorship payment. And there's actually very detailed regulations that the IRS put out on this. Rare for them to ever do this. They don't usually put out helpful detailed regulations in the exempt organization area on anything, but they did here, and they're very specific. So they say, like, for instance, what the IRS views as not being a substantial return benefit are acknowledging the sponsor with the sponsor's name and logo, contact information, address, link to the website, non-qualitative description of the sponsor's product or service, but things that are not consistent with a, being just a mere acknowledgement without a substantial return benefit, or if you're using qualitative language or comparative language about the sponsor's product or services, if you're providing an endorsement to the sponsor, if you're including or they're including price information in whatever they're putting out in connection with the sponsorship, and any other benefit that is provided that is valued at more than 2% of the amount of the contribution is going to be considered a substantial return benefit. And so the way it works is that whatever is subject to a substantial return benefit, whatever that amount is not subject to the corporate sponsorship exception, but the rest of it, whatever the rest of the fair market value is and can be subject to the exception if it otherwise complies. So the way to deal with this issue, yes, getting free tickets to a registration to a conference or tickets to a dinner or something like that is usually going to be more than 2% of the value of the payment. So it typically would trigger this and mean that amount. That's why in the past your organization, Laura, has tried to avoid doing that, because you don't want to provide a substantial return benefit. But the way to get around it is in your agreement, and these always should be subject to a written agreement. In your agreement with the sponsor, you break it out into two different sections. One is the payment for the conference registration fee, which itself is not going to be subject to unrelated business income tax because it's related to your mission and purpose. So it's all tax-free income. So let's just say, I'm just using fake numbers. Let's say it was the total payment that the sponsor's paying is $100. $30 is the value, the cost of the conference registration, and $70 is the sponsorship. Your contract would break it up to say, all right, we're charging you $30, maybe $300, but you know what I'm saying, $30 for the conference registration fee. You're going to book that as program service revenue on your 990, and that's going to be tax-free because it's related to your mission and purpose. And then you're going to book the $70 as a tax-free corporate sponsorship payment, because the benefits they get in return for that are consistent. So you're basically splitting it off. You're kind of taking that conference registration fee, shifting it to another box. And so we don't have to get into that substantial return benefit analysis or anything like that. That's the way to do it. That's how we've been doing it for years. And sometimes it's even more than that. Like, there's a lot of larger organizations that bundle all sorts of things for their corporate partners. There's all different names that people use, but so it might be conference registration fee, it might be a exhibit booth at a trade show, it might be corporate sponsorship, it might be advertising in your magazine or newsletter. It could be membership dues as well. Sometimes everything's bundled together. That's fine, but you just want to break those things out in the contract so that you can show, if the IRS ever audits you, here's all the different buckets. And, and sometimes by the way, if you have like an endorsement or affinity program, you might be getting royalty income. That could be part of it as well. So you break it out, this part is a royalty, exempt from UBIT. This part is corporate sponsorship, exempt from UBIT. This part is qualified convention and trade show revenue, exempt from UBIT. Oh, by the way, yeah, when I said program service revenue, it would probably be booked as qualified convention and trade show revenue if it's a classic convention. This amount is membership dues, also exempt from UBIT, just because it's related to your mission and purpose. And then finally, the advertising portion is the only portion that would be subject to UBIT. And you're supposed to do that allocation on a fair market basis. I did a whole in-person program last week in Nashville on UBIT issues, and someone asked the question, we do these big bundling of all this stuff, but we don't want to break out the dollar amounts to the corporate partner. We don't want them to know kind of what those are. And, while it's not the perfect solution, I'm fine with that, so long as you break it out internally. Even if you don't tell the sponsor, you break it out internally. And from the sponsor's perspective, they don't care. Right? They just care what they're paying and what they're getting. They don't care how you treat it for tax purposes. They're almost always taking a business tax deduction for the whole amount. So they don't care, they just care about the total, but internally, it's very important to break that out. Sorry for the long answer.
No, this is so helpful. This has been an ongoing, I mean, years long conversation, and we're like, we've got to get some legal advice to really inform this moving
Yeah,
forward. So this is incredibly helpful. Thank you.
This is the way to do it. And take a look at that article. It has an overall, background summary of the UBIT issue generally, and then it does a deeper dive into royalties, corporate sponsorships, and qualified convention and trade show revenue, all three of which are exceptions from UBIT, like I said.
Great, that's really helpful, Jeff. Thanks so much. Really appreciate it. We have just a few minutes left. Those are all the questions I have in the queue. So if there's another question anyone has, now's the time to ask it. So give folks a chance to do that. And if going once. Christine.
I have a question. It's just a little complicated. The way it came to me is a little complicated, so I'm trying to ask it in a non-complicated way. So the question is, the IRS doesn't generally consider trying to influence executive branch agencies or their administrative rules as lobbying. But here in Wisconsin, the legislature has the right to approve or deny almost all the rules that are drafted by the state executive branch agencies before they become final law. So if the legislature doesn't raise an objection by a certain deadline, like they have influence. So one of our members is wondering, since the legislature has to take action on these rules, wouldn't that mean that, at least for Wisconsin, meeting with government officials on the executive branch side or on administrative rules does actually qualify as lobbying?
Yeah,
that's a catch.
That's a great question. And so again, we're talking about the IRS C3 rules, but they apply to state lobbying as well and local lobbying. Yep. So in that situation, like phase one of that whole initiative, when it's just in the executive branch, whatever lobbying is being done, and I'm using kind of lowercase L lobbying, whatever lobbying is being done of the executive branch, that's not going to be considered lobbying. But once, the executive branch proposes something that goes to the legislature, then any lobbying you're doing with your state legislature, members of the legislature, their staff, to try to support or oppose, the approval of the agency action, or if you want them to deny the agency action, that part is going to be considered lobbying. And one other kind of corollary rule, kind of the reverse. I just did a training session for a large C3 client of ours a couple of weeks ago here in DC, and we spent a lot of time talking about this issue because it's relevant to what the work they do. If you are talking to legislators about executive branch actions, so in your example, you're talking to the legislator about legislative action because they have to take a vote. But sometimes, especially, I'm sure it works this way in Wisconsin, I know it works this way in Washington, a lot of times members of Congress and committees, they have great influence over what agencies do and how the appropriated monies are spent. And for this one client of mine, it's a huge issue for them. So they spend a lot of time talking to usually staff members of committees and whatnot, the ones who wrote the legislation and made the appropriations, to get them to put pressure on the agencies to do certain things, spend more, to spend less, to spend money in a fiscal year, all that stuff. That's actually not considered lobbying. Even though you're talking to a legislator or legislative staff, because you're not talking about legislation, it's not considered lobbying. But on the flip side, if you're talking to a member of the executive branch about legislation, because that also happens, where members of the executive branch will weigh in with legislators on legislation and try to push things. That actually is considered lobbying. So you just always got to think about it. Does it involve legislation or not? It's not with whom you're talking. It's about, it doesn't involve legislation.
Thanks so much.
Excellent. That's really helpful.
And then, take a look at the article, but it also talks about certain other things like Senate confirmation here in DC, Senate confirmation of judicial appointees. That's considered legislation as well. And you probably have that in a lot of states as well.
Yeah, the article you wrote looks amazing. Thank you so much for sharing.
Sure.
We are at time. Time flew by once again, Jeff.
Mm.
Appreciate your time. Thanks so much. And we will be sharing the recording out with our network, and we'll be sharing out these links to the articles you share with us too, Jeff.
Right.
So thanks for your time. Thank you. Thank everyone who was on the call today.
Right.
Be
Thanks,
well. Have a
everyone.
good
We'll
fall.
See you next quarter.
All right. See you next quarter. All right.
Take
Take
care.
care, everyone.